3 credit cards hit zero on the same day, one loan, one payment, one fresh start. Then a car repair goes back on a card. Groceries follow. A year later, the consolidation loan is still there, and the card balances are back. He did not escape the debt. He stacked new debt on top of the old debt. The cards were paid off. Alex was not debt-free. That difference is the trap. The problem begins with the moment that feels like success. The balances disappear, the payments become simpler, and the pressure finally drops. For many people, consolidation genuinely looks like a solution. Multiple credit cards with different balances, different minimum payments, and different due dates create real mental load. Missing a due date can trigger a late fee. Juggling 4 payments across a month when money is already thin is exhausting. A consolidation loan promises to reduce all of that to a single payment, sometimes at a lower interest rate. The monthly obligation may feel smaller. The stress temporarily lifts, and when the credit card balances drop to zero, there is a moment that feels like a fresh start. For someone who has been watching those balances grow for months, that moment is real. The relief is not imaginary. The organizational benefit is not imaginary either. But relief and resolution are different things. The debt did not disappear. It changed addresses. Alex had 3 cards totaling $12,000. A personal loan paid those balances. The cards now show zero, but Alex still owes approximately $12,000 to the new lender, not the card companies. Now let's talk about the lower monthly payment, because this is where the numbers need attention. Take a hypothetical example. Suppose Alex owed $12,000 and had 2 different loan options in front of him. Option A costs about $435 a month and pays the loan off in 3 years. Over that period, he would repay roughly $15,600 in total. Option B costs about $290 a month, which is about $140 less every month. It pays off over 5 years. Over that period, he would repay roughly $17,500 in total. Option B feels more affordable every month, but it costs approximately $1,900 more in total. These are hypothetical figures. Actual rates and terms depend on creditworthiness, the lender, and current market conditions. But the direction is what matters. A lower monthly payment can come from a genuinely lower interest rate, from a longer repayment term, or from both at once. When the term stretches, monthly payments fall, but the loan lives longer and interest accumulates over more years. A smaller monthly payment can hide a much longer financial obligation. Before accepting any consolidation offer, 4 numbers deserve attention: the interest rate, the fees, the total number of payments, and the total amount repaid. The monthly payment alone does not tell the story. And speaking of fees, origination fees can quietly affect how much of the loan actually arrives. If a $12,000 loan carries a 5% origination fee, $600 is deducted before the money is deposited. The borrower receives $11,400, but repayment is calculated on the full $12,000. That gap matters. Some loans carry origination fees, others do not. Some balance transfer cards charge a transfer fee, typically 3 to 5% of the amount moved. These are not automatic disqualifiers, but they are part of the real cost and need to be counted in any honest comparison. Now, for the part that tends to surprise people. After consolidation, the credit cards are at zero, and in most cases, they stay open. The available credit is still there. The cards are still in the wallet. That available balance can feel like an emergency cushion, and when a real emergency comes, a car repair, a medical bill, an appliance that fails, it can feel responsible to put it on the card rather than miss a loan payment. The most dangerous moment may be the day the credit cards reach zero, because that is the day they become available again. A standard consolidation loan usually does not freeze those credit card accounts or prevent them from being used again. Depending on the account and the product, the available credit may return once the balance is paid, and the card continues to work as it always did. One charge becomes two becomes a pattern. A few months later, The card carries a balance while the consolidation loan is still being repaid. Now, there is a loan payment and a minimum payment. The total monthly obligation is higher than before consolidation. That is how double debt can form. The consolidation loan remains while new credit card balances begin growing beside it. And this points to something the loan itself cannot fix. Debt consolidation reorganizes existing debt. It does not increase income, reduce the cost of housing, repair a car, or cover a medical bill that insurance did not. It does not create an emergency fund where none existed. It does not change the number of weeks until the next paycheck. If the monthly budget runs short by $300, moving $12,000 into a new loan does not close that $300 gap. The same income goes in, the same cost of living comes out. If those two numbers were not aligned before consolidation, they will not automatically align after it. This is not a judgment about spending. Many people carry debt because of rent increases, income that has not kept up with costs, medical expenses, irregular hours, or gaps between when bills are due and when money arrives. Consolidation cannot fix those conditions. It can only reorganize what is already owed. So, when does it actually help? Consolidation can work when the new interest rate is meaningfully lower and the savings are not erased by fees. When the rate is fixed, not a promotional period that expires and resets higher. When the repayment term does not stretch so far that total cost increases significantly. When the monthly payment fits within the actual budget, not just barely, but with room for the unexpected. When the old cards are no longer used for new balances, whether they are frozen, removed from the wallet, or closed when appropriate. When automatic payments reduce the risk of a missed due date, and when whatever caused the balances to grow has been identified and addressed. The loan is not the trap. The trap is using the loan as a reset button and expecting the reset to hold without changing anything else. Before accepting any offer, a short checklist helps. What is the exact APR? The annual percentage rate, which reflects the interest rate and certain required loan costs. Is the rate fixed for the life of the loan or variable? What are all upfront costs? What is the total number of payments and the final payoff date? If it is a balance transfer card, how long is the promotional period and what does the rate become after it ends? Does the loan involve collateral that could be at risk if payments are missed? And the most important question, what specific plan prevents the old card balances from returning? If a personal loan is the leading option, comparing it against a nonprofit debt management plan is worth the time. Credit counseling agencies that operate on a nonprofit basis sometimes negotiate reduced interest rates with creditors and offer structured repayment programs. They are not the right fit for every situation, but they are worth understanding before committing. Debt consolidation can organize payments. It may reduce total interest when the terms are right. It can create genuine breathing room in a month that feels impossible. But it cannot turn borrowed money into income. Moving debt can be useful. Mistaking movement for progress is the trap. The question is not whether the consolidation worked on paper. The question is whether the account you paid off is still at zero.